The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us for today's free webinar, Building Your Financial Model, Key Startup Metrics with Cirque Rowe from Early Growth Financial Services. My name is Gina Longmire, and I'm the Marketing Manager for Early Growth Financial Services, and I will be your moderator today. This presentation will run about 40 minutes. If you have any questions as we go along, please feel free to enter them in the question field or tweet them to us at earlygrowthfs with the hashtag startupfinance. We will answer questions as they come in if we can. If not, we'll wait until the question and answer period at the end to address them. If we run out of time, we'll be sure to follow up via email after the presentation to make sure that all of your questions have been answered. We'll also send out a deck to this presentation tomorrow with an email for contacting should you come up with questions after the presentation. I want to first start by introducing Cirque Rowe. Cirque is the Chief Operating Officer for Early Growth Financial Services. Cirque has 25 plus years of financial experience, with 17 years serving in financial leadership roles with high-tech companies. He's also an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. Welcome, Cirque. And before we get started, I wanted to have Cirque tell us a little bit about Early Growth Financial Services.
Thank you very much, Gina. Good morning, good afternoon, everyone. It's a pleasure to be here with you, and we're going to be talking about building a financial plan. But first, a little bit about Early Growth Financial Services. So we are a national outsourced financial services firm. We provide basically four types of services. We do tax returns, corporate tax returns. We do valuations of companies, for 409A valuations, for example, for companies that provide stock options to their employees. Those have to be done on an annual basis. We provide bookkeeping and accounting services. So that's kind of the month-to-month, day-to-day transactional work that companies should be doing in keeping their books in order. We push for GAAP-compliant, accrual-based financials, and we do full balance sheet account reconciliation so that when you get financials from Early Growth, that you can be confident that they truly reflect the financial condition of the company at that point in time. And finally, we provide CFO-level services. And that would be for higher level strategic types of things, as well as things like putting together a financial plan and helping with fundraising and looking at possibly taking on debt and equity. Any other thing that you would typically go to a financial executive for, we provide that service. But instead of hiring someone internally or even someone on a half-time basis for early stage companies, you don't have that need for that much work. And so bringing someone like Early Growth in on an hourly basis probably will make a whole lot more sense to you. And having that kind of that clout behind you, making sure that you're keeping on the straight and narrow. In terms of your financials, will be fantastic for you today as well as going forward, especially if in the future you're going to be doing any kind of fundraising. In addition to the work that we do from just the accounting and financial perspective, we are also very, very much part of the ecosystem of service providers that work in the high-tech space. And so if you're a company that is ultimately going to be going for fundraising, whether it's to angel investors or VCs, traditional venture capitalists, then we work with a lot of the firms that play in this space and can help you with those efforts, as well as making introductions to you, to investors. Okay,
Great.
so with that as a background,
Sorry, Cirque, I didn't mean to interrupt you. I was going to say that was a great introduction, and if we want to go ahead and get started.
Fantastic, yeah. So, okay, so really, we're going to be talking about a financial plan, and depending on how much experience you have with this, I know it can be considered a mundane and a little bit tedious type of work. It's a little bit painful at times, but really, in order to, if you really want to do it correctly, there are some steps that you have to follow, and if you do it correctly, then hopefully what you'll get is a plan that can help you navigate your company, navigate the future, as well as to use for things like talking with banks and other lenders and talking with equity investors, because all of those types of people, outsiders of your company, are going to want to see what your plans are and make sure that it makes sense with what you're trying to do, and it also makes sense for you as well. But really, it's about building a story, right? It's about the numbers coming from your financial plan. It should be about the story that you have to tell about the opportunities that you have with your company, with your product, with your service, the customers that you're going after, and all the resources that you're going to need in order to meet these demands. And using all of those things, if you can put together this story that is your financial plan, then again you'll be in a position to be able to manage the company better and to be able to talk with outside, whether it's investors or with bankers or with vendors and anyone who you're basically doing business. You should have an understanding of what those financials look like. So this is kind of what we're going to be talking about. Gina, if you could go to the next slide. So this is, we're going to be talking about what investors are going to be looking for. And for, kind of at the basic level, we're going to be talking about what a financial model is and the time frame that you should be looking for it. We're going to talk a lot about milestone funding and the objectives that you're setting for with your financial plan. That's hopefully going to enable you to go after funding if that is your goal, or to figure out how you can bootstrap your company so that you are successful without having to go for outside financials or funding. We'll talk about bottoms-up financial projections and why it's very, very important to do a bottoms-up financial projection instead of doing a top-down projection. We'll obviously talk about spending and budgeting, and we'll talk about a little bit about reforecasting and the importance of doing that, because one of the mistakes that I see being made is entrepreneurs or management teams say, okay, well, we need to put together a financial plan, so let's put together a financial plan, and we work to for a month or so putting together a financial plan, and then we say, great, did that, now let's put it away in the drawer, and we've got this and we can always refer back to it, but then we never do. And without doing that, then it basically misses really the point of what you're trying to do, because we're going to be changing. We use the word pivot all the time, right? Companies pivot, product development pivots, customer acquisitions pivot. And whenever those types of things happen, what you have to do is you have to reforecast, because you always have to be knowing what's going to be coming down the pipe as opposed to what happened in the past. Okay, so we talk about doing a three-year financial model, and there's differences between doing what I would say the 3 to 5 year, which is kind of the intermediate term model, versus kind of the 1 year budgeting process. You have to do both, but you first really have to start with a 3-year financial model, because this is really going to it is what you're going to be using to determine kind of how much money you need. Where are you going to get this money from? Is it going to come from customers? Is it going to come from myself? Is it going to come from friends and family? Or is this the kind of business that can and I should be able to go out and raise external financing from VCs and or angel investors? And so the 3-year financial model and showing the growth in revenue, showing the opportunities, and showing the resources that you need in order to meet those opportunities is going to drive, who you go to for external financing, or whether you're going to be able to do this and bootstrap it on your own and grow the company from customer payments. So when you look at this 3-year financial model, these are the things that you're gonna try to get out of it, right? You're gonna obviously understand your cash burn, and by cash burn I mean especially if you're in a position where you have raised money from outside investors, or you're going to raise money from outside investors, or you've taken money from friends and family. Then you need to understand how much cash you're burning on a monthly basis, quarterly basis, annual basis, as well as obviously how much cash you have left, and therefore the projected runway that you have on the cash that you have, because that all will obviously drive when and how you go after additional financing. it will validate your assumption, and that's a key one because your model is really going to be driven off of some key assumptions, and we'll talk about that a little bit more in the future, in the future slide. But your financial model will really validate what those assumptions are and how sensitive your model is and how sensitive your financials are to certain assumptions. Because I will tell you that when you think about the totality of putting together a financial model, you think of, oh my gosh, I have to figure out how much hiring I'm going to be doing, and I have to figure out how much advertising and rent and office supplies and travel and entertainment, and boy, there's just so many factors. But I'll tell you that the bulk of the financial model is going to be driven off of probably 5 to 7 key assumptions, and the rest of the other stuff is whether there's variability in those other kinds of expenses is going to be a very, very minimal impact compared to those 5 to 7 maybe key assumptions that you have in your model. And so this is the 3-year financial model will really drive that home as to which assumptions are the important ones that you need to be focused on, that you really need to keep your finger on the pulse of. We talk about iterating progressively. We will, and ultimately, if you put together the right financial plan, this is going to give you leverage. So that when you say that, hey, I've got a company that's worth this, I've got a company that I think I can raise this amount of money on, you're going to be able to say this is the model, and as long as we can come to agreement that this is the opportunity that I have, and these are I can achieve these kinds of milestones in terms of financials, then that's a great baseline to have a discussion about valuations with investors, so that you're getting a fair valuation on your company as you go and raise money. And oh, by the way, I don't think we discussed this. So we're covering a lot of stuff here. As questions pop up, please go ahead and type them in into the discussion dialogue box. I think Gina is monitoring that. And then when there are questions along the way, I think, and to the extent that they're pertinent to what we're talking about, I think Gina will just kind of pipe in and raise those questions. Otherwise, we'll answer questions at the end as well.
Yes, definitely. Yeah, we mentioned. I think I mentioned that in the beginning. But yes, as questions come along, if you guys have any, please feel free to type them into the question field, and Circle answer them as we go.
Fantastic. Okay, so what goes into a 3-year financial model? And these are kind of the main things, and it's just kind of like a round robin. It's an iterative process.
Sir, yes. I don't mean to interrupt you, but be careful what you ask for. We have our first question.
Fantastic.
It says, is this model similar whether it is B2C or B2B?
Absolutely. The model is similar. I mean, obviously, the inputs that you're putting into the model are going to be different, but the model is similar. And we'll talk about kind of what the model is made up of, but it's really probably depending on how in depth you want to get. The best model to me is a complete financial model forecast, which includes the 3 major financial statements, pro forma financial statement models, and those are the income statement, the balance sheet, and the cash flow. And really, if you really want to do it right, and if you really want to understand where your cash is going, then you really want to do all 3 of those things. You can do a hybrid, and a lot of companies do, especially early on when they don't have a lot of, for example, capital expenditure requirements, other things that impact your balance sheet, but it's more about a spending business, and it's more about an income statement-based business. Then you can do kind of a hybrid where you really just kind of look at an income statement with some additional kind of line items for additional cash requirements, for example, and you can get away with that. But for the most part, yes, the model is going to look the same. The inputs and the assumptions that go into the model are obviously going to be very, very different, whether it's a B2B or a B2C or a service company versus a product company, or a SaaS or a software as a service type of company versus an enterprise service company. So obviously, depending on the company, the model is going to look a little bit different. But in terms of the actual way you think about putting together the model, it's going to be the same. I hope that answers the question. Okay, actually, can you go back, Gina? So these
Sorry,
are some of the
I
things that we're going to
accidentally.
be looking
Yeah.
at. It starts with the major objectives, right? So what are your objectives? Are you trying to build a company that is going to be fundable? I'm sorry. Are you going to build a company that where you're going to be able to grow it slowly, and you're going to be able to do it based upon getting initial customers and having them pay for it, and using the proceeds from the customer payments to grow your company slowly? Or are you a company that is has a huge opportunity, and you have kind of that hockey stick, the hockey stick effect on the revenue, such that you think that you're going to be able to go after a huge market opportunity, and so you need a lot of investment dollars to go after it. It's going to be those kinds of major objectives, and based upon those major objectives, you have to look at milestones. And milestones is kind of what I talked about at the offset. We are a milestone driven company. We tell all of our clients that's what you got to be looking at, and especially when you're looking at fundraising. What are the milestones you're trying to achieve, and how much cash and how many resources am I going to need to hit those milestones? And it's answering that question, that key question, really to me is going to drive how much investment you're trying to get, who you should be going after in terms of the investors that you should be talking to, whether it's banks or lenders or friends and family or angel investors or traditional VCs. Obviously, key assumptions, like I said, I mentioned that in most models, 5 to 7, maybe 10 key assumptions are really what's going to drive 90% of the model. This is that classic, to me, the iceberg, right? You see, well, not the iceberg, but it's that 10-90 rule, where the top 10% of the assumptions will cover 90% of the results, and then the rest of that 90% of the assumptions only cover the final 10% of the results. And so focusing your attention on that 10% of the key assumptions is really, really important. And then obviously timeline. So timeline is really, really important to understand, again, how much cash you need, how much you're going to be burning, what you're going to do in this timeline of cash that you have available, such that when you get to that end of that timeline, especially if you're kind of going after that angel round of financing, followed by a Series A, followed by a Series B, which is kind of a traditional way of raising money here in Silicon Valley for a tech company, that you understand what that timeline is, when you're going to hit those milestones, making sure that as you're hitting those milestones, you're still hitting what the market needs are, and so that when you're able to do all those things, that you'll be able to get that higher valuation for your next round of financing. Okay, and so kind of, again, looking at those major objectives, and it really comes down to two, right? It comes down to, are you going to be able to start making money with the investment that you have, whether it's personal investment or friends and family, but do you have the kind of company, let's say, for example, you're a service company, and you provide consulting services, right? That doesn't take a lot of money to get started. You have some expertise that you can sell to the marketplace, and you can start making money right away. And so then you take the money that you're earning from your consulting services, and you bring on more clients, and you do a little bit of sales and marketing, and maybe you hire another person and a third person, and so now you've got some positive cash flow already, and so you don't necessarily need additional financing from outside, and you're able to maintain control of your company. In a company like that, then obviously you have very, very different types of financial planning than you do for a company on the other side, which is what I call the investable company that has a big market opportunity. You can see a huge revenue increase over time, but in order to hit that, you have to invest some dollars, whether it's product development, whether it's software development, whether it's sales and marketing. If you've got a website that a social media, for example, or social networking website that is really needed in the marketplace, and yes, you're going to make some money in the long run in terms of advertising, but in the meantime, I need to really, really get users up, and I need to get users spending more and more time. Well, obviously, that kind of effort takes product development on the website, as well as obviously a lot of marketing dollars and advertising dollars and getting the word out. And so companies like that typically require funding from investors, whether it's angels and venture funds, and you're going to have some negative cash burn. So between those two different types of companies, you have different objectives. Your financial model is going to look different, and the goals that you're trying to accomplish are going to look very, very different. So your financial model should obviously point that out and make it very, very obvious to anyone looking at it, as well as for yourselves and for your management team, of exactly what the objectives are. Okay, so here's the process, and again, it's going to be a little bit different depending on how big your company is, whether you really have an executive team, or whether you're just a sole entrepreneur, or one of two founding team members. Obviously, it looks very, very different, depending on those things. But basically, what you want to do is you want to, get the entire set of stakeholders involved, right? You want to make sure that the technical guy understands exactly what resources he needs to develop the product, for example. So you need to understand from him, how many people he needs to hire, when he needs to hire them, what level are they? Are we going to need to use outside consulting firms to help with some of our product development? Can we do that? Going overseas with contractors, or do we really need specific expertise that we only think we can find here in the United States, and where in the United States? So those kinds of questions are really, really key drivers as to how much of a spend you're going to be having to spend. Obviously, the sales team and the marketing team, in terms of what kind of revenue they are projecting based upon where we are, or where the product needs to be in order for us to start taking it out to the public and start selling the product, and what kind of projections they have. What kind of a team do they need to make the revenue happen, right? Do we need an internal sales team, or are we going to outsource our sales efforts? Are we going to use an outside sales team? Are we going to do co-sharing of revenue with partners? So all those types of questions are questions that you have to ask that need to go into the model. And obviously, someone, and whether it's the CEO, or whether the founders, or whether it's whether it's a financial executive, should be compiling that information, and then putting together kind of the assumptions and driving up the model. And then you're gonna want to do you're gonna have trade-offs, because I can guarantee you one thing: if you go to 3 or 4 different people, executives of the team, or stakeholders of the team, and you ask them what resources they need, I guarantee you that the totality of all those numbers is going to be way, way, way more than you think you can afford. And so you're gonna obviously do an iterative process where you go back to the team and you talk about, well, we can't spend this much money in totality, so what can we do? What are the trade-offs we have to make? And make sure that you get buy-in, because the one thing that you don't want to do is to put together a plan where key members of your stakeholder team feel like the objectives are not achievable, given the financial constraints of the budget. And then we'll talk a little bit about doing a bottoms-up forecast. So the bottoms-up forecast, and this is really, really key for me. I see too many financial plans that are put together from a tops-down perspective, and the tops-down perspective says something like this: well, a study is showing that the potential market for my product or service is will be $100 million in 3 years, and so I think I'll be able to achieve 2% of that, and so I think I can hit $2 million, or whatever the assumptions are, but using high-level assumptions to determine what you think you're going to be able to do in terms of revenue, and then using that as a means of kind of the baseline to kind of, and then say things like and so I'm going to do $2 million of revenue, and I think cost of goods is going to be 30% of revenue, so it's going to be $600,000, and then my R&D expenses is going to be 20%, and my marketing expense is going to be 30%, and so using those types of kind of industry averages or percentages, and using those as a means of preparing a financial model, I will tell you that is just absolutely not the way to do it. You have to do some of those things to at least make sure that you're in the ballpark, and to make sure that the financial model that you're putting together makes sense. But really, if you really want to have a model that you can use from a management perspective as well as from an investor perspective, you have to do a bottoms-up financial projection. And so that's kind of what we talk about. When we talk about bottoms up, we're talking about things like, okay, look, we've got evidence that shows that, if we send out 1,000 emails, to potential customers, then we can expect, 100 of those people to open up the email, and we can expect 20 of those people to click on the link that will take us to our website. And once they're on our website, we can expect 25% or 5 of those people to actually spend more than 5 minutes on our website. And it's that kind of metric, it's that kind of understanding and of the metrics that will drive the revenue or drive the whether it's people on your website, amount of time being spent on your website, whether it's revenue, whether it's number of customers, how much they're paying. All those types of things you have to do from a bottoms-up perspective. And so the revenue that you're trying to generate in your financial plan should be a combination of those things. So I can expect this much revenue from this many emails that I'm going to send out, and then once I have that, then I can expect 5 customers to sign up to our service or to our software, and they're each going to pay $500 a year, $1,000 a year for this service. And I can expect every customer that signs up, I can expect them to stay with our service for 3.5 years or 4 years. And using those kinds of assumptions is how you build up this model. And so I'm going to, in the first year, I'm going to sign up 100 customers. In the second year, I'm going to sign up 500 customers. In the third year, I'm going to sign up 1,500 customers. And oh, by the way, now the people in year 1 are going to start dropping off because I can expect a certain percentage of those to drop off. And so those are the kinds of questions and assumptions that people are going to be asking to make sure that you understand exactly what's required. And when you do that, then you have a basis to say, okay, well, what would it actually take for me to sign up 100 customers in year 1? What kind of a sales team do I need? What kind of advertising do I have to do? What kind of marketing do I have to do? Is my product development sufficient enough to be able to attract 100 customers? And it's all of those things that you're going to is going to kind of develop as you do a bottoms up estimate. And when you do all those things like the amount of spending that you need, the headcount and the projections that you have for hiring, and whether you're using consultants, all that stuff will precipitate out of this bottoms up model.
Cirque, really quickly, we have another quick question, and it says, how can we do bottoms up projections if we don't have any users or product built in? Or to rephrase it, how can we pull together these assumptions without any product or users to get the data?
Yeah, that's obviously a very, very good question, and obviously putting together financial models when you're first starting out, when you don't have a lot of data, is very, very difficult. And I would say that it's certainly more art than science, especially early on. What I would do is I would point you towards publicly available information out there for other companies that are similar to yours in terms of whether it's in the same type of space or whether it's delivering the same type or the same methodology of delivery of your product, whether it's a SaaS-based business. And so things like, okay, I have a SaaS-based business that's a B2C. I'm expecting customers to. It's like a freemium model where I'm going to be able to get customers to try us out. And then at some point they're going to start paying for premium services, for example. And in that kind of a model, then I would say that there's a lot of evidence, a lot of data out there on the internet where you can do searches of companies and you can look at kind of past histories of companies to suggest, hey, this is kind of what it takes, right? You're going to get 1,000 people to sign up. From 1,000 people that are signing up for a free service, then you can expect 10% to sign up for the premium service and pay for it. You may have an advertising model, so you may have a social networking website that is going to make their money not by charging your client, your users, but by charging companies to advertise on your space to get the viewers to look at their advertising. And so there's tons of websites and other social networking sites that do that, and you can do searches to determine kind of what their model look like. So there will be data, no matter what you're doing. I guarantee you that there will be data that you can find to help you frame kind of what your business looks like and what you may start to do. I'd say the biggest one really though is going to be trying to do a bottoms up of your revenue projection, right? If you can do a bottoms up of your revenue projection, then I think you're kind of already, I'd say more than half the way there, because that's kind of the biggest number, and a lot of the rest of it kind of drives up from that. But in order to really do it, you do need, the more data you have, the better, and that's why we will talk a little bit about the iterative process too, because you know what, I guarantee you that no matter what you put together in terms of your initial forecast, it's going to be wrong. And it could be wrong by 10%. It could be wrong by 100%. It could be wrong by 10,000%. But it will be wrong. The point is that you've put some science, you've put some assumptions behind it. The assumptions are backable, and you kind of put that model together. But then you iterate, right? So after you do your first email campaign, after you do your first advertising campaign, after you do your first keyword advertising campaign, for example, those types of things will give you data. You'll see, okay, well, I put an advertising campaign together on Google for these keywords, and this is the feedback that I got. And these are the hits that I got, and from those hits, this is the amount of time that I was able to spend. So there's lots of data out there to be able to mine, to be able to give you better and better data over time, and you should be using that data to continue to hone and iterate on your model. If you're using this from obviously when you're first really starting out and you don't have any of this data, well, you're not going to be going out for outside investors at this point anyway, right? You're just kind of doing stuff on your own, a little bit of money on your own that you've put together, maybe from savings or from credit cards or whatever. A lot of people do that, and they start the process, right? And they start getting data, they start putting a product together, they start doing advertising, and so you'll get over hopefully a very, very quick amount of time, you'll get a lot of data to be able to use. If you have a product that is like more of a hardware type of product, where you actually have to develop something and spend a lot of money developing a product before you sell it, it's harder. And hopefully you'll be able to point to other companies and other products that are similar, whether it's in terms of cost or whether it's going after a similar type of customer base, and you'll hopefully be able to get some data to use to be able to assist you in preparing the model. But there are no hard and fast answers on this one. It is going to be harder when you're first starting out, and all I can do is say, hey, there's lots of data out there for you to mine to help you, and if you don't have the wherewithal to do it, you should be asking for people who do understand the space to be able to assist you in putting some of this stuff together.
A quick question in regards to some of the sites. Are there sites that compile
so,
Oh, sorry. Just quickly, I have one more question that in response to your discussion of the sites,
sure.
Do you know any off the top of your head that you can maybe suggest that compile data on competitors to do the bottoms up model that you suggested, or is it more of a Google search?
Yeah, you got to do a Google search. Obviously, you'll and some of it you'll have to pay for, right? There's pay sites. There's obviously, if it's publicly traded companies, that you're doing searches on. There's a lot of free data out there because it's public domain data, the financial results, and even some of the notes. Like getting annual reports from companies. You can do that. But there's also, if you do Google searches, I mean, that's a great thing now. It's just there's just so much information. It'd be impossible for me to answer that kind of a question just because it's very, very specific on the type of company that you have and the type of product and service that you have. But I would just kind of start doing some searches, start looking around. As you start doing that, you'll probably and what I've always found is this, that what's really interesting to me is this, that when I start doing searches, whatever I may be doing searches for, but I'll try to think about different ways of attacking it and using different keywords to do searches. And a lot of times, what happens is it kind of I get kind of diverted towards a specific kind of set of data and set of documents and a set of sites that have this kind of information. And then you use that, and usually, when you start doing searches on there'll be places, hyperlinks from those sites to give you more information. So I would just start doing that and see what you can find, and that's kind of the first thing. If you are not successful doing that, then probably what you're probably talking about doing is, and if you're really serious about it, you're probably talking about paying for studies. Right, there's lots of places that do this kind of work for you, right, and prepare industry studies and industry data, revenue growth and hit rates and all those types of things, and obviously, some are more expensive than others. Some are free. Some you will give you some free reports to start, but then obviously push you to buy more detailed data, for example. So there's lots of places that you can go, and hopefully you'll be able to get some information and a lot of it for free, and then pay for very, very specific things that you need where you're not able to get some free data.
Great. And then quickly, I have another question. Could you go into a little bit? Are we going to go into more detail on the bottoms up financial projection, or is this something they should privately ask you about?
Yeah, so I will spend a little bit more time. I think the next slide actually speaks a little bit on the spending for bottoms up projections. But yeah, it's hard to go into much more detail than that at this level, just because I think going into more detail really, really requires an understanding of kind of the business that you have, and what are the key drivers of your business, and let's focus on those, and how do we get to the bottoms up estimates and bottoms up assumptions that are going to drive your particular model. But basically, these are the types of things that you're going to be looking at from a spending perspective, right? So the revenue side of it is absolutely probably the most important thing. Understand what it takes to actually get customers, how much they're going to pay for your product, how long you're going to keep those customers for if it's some sort of like a software as a service model, how long you keep users for if you have a social networking model, how quickly it grows, and whether it's a viral type of company, or whether you're getting users and customers one by one. All of those things are really, really critical. Once you have that, then you obviously need to think about, okay, based upon us being able to get these kinds of revenues and the assumptions behind it, this is what we're going to have to be spending money on, right? So it's about customer acquisition cost. That's a key one for me to understand, depending on the kind of company you have. I think people underestimate what it actually takes to acquire a customer, both from a standpoint of time as well as cost. And so I want to make sure that you understand what it actually costs to obtain a customer, and whether that's, like I said, in terms of advertising, whether that's salespeople, or using outside sales agencies, using partners, all those things cost money, and people usually underestimate that cost, especially in early stage companies, because it always costs a whole lot more to get the first set of customers than it does later on when you've got your name out there and people are talking about you, and you're getting more people signing up for your service or product because you've already had some success. Obviously, the human resource cost, that's going to be the biggest one from a cost perspective for most companies. And these are the salaries and the benefits and the overheads associated with hiring people. Consulting, professional services, so things like, obviously specific consultants that you need to use, whether it's from a product development standpoint, whether it's from a sales perspective, marketing, and certainly, even professional services like legal fees and accounting fees are obviously important. But I would say that unless you have, like, for example, a lot of IP or intellectual property that you're trying to protect with patents, then I'd say that legal fees, and accounting and other types of professional services for the back office should not be a big cost to you at this point in time. Research and development, obviously, depending on where you are and how easy it is to put together the product or service offering that you have, will be very important. The sales and marketing, absolutely. This is really, really critical. I think, again, people underestimate how much it actually takes in terms of sales and marketing dollars it actually takes to start acquiring customers. So, this is an area where you will see a lot of free data, and you'll see a lot of studies out there that talk about customer acquisition costs and who you have to hire and what kind of hires make sense for different types of industries and different types of product offerings. Capital spending, if you have a company that is obviously, that's building something, whether it's inventory or whether it's actual, hardware that you have to purchase. If you're a data service company that has to buy a lot of servers and networking gear, all those things obviously you have to take into consideration. More and more, we're finding people are doing more with less, and so this is becoming less of an issue for a lot of software development companies. But obviously, if you are a hardware-based play, then you need to keep in mind the spending you're going to need to do on the capital side. So, in the next slide, there's a lot of bullet points here. I wouldn't focus too much on it. I would say that, this is where you kind of put together that budget of, okay, this is the budget that I'm putting in place based upon the milestones that I'm trying to meet. And, you can look at it different ways. For real small companies, I would say if you take a look at the third bullet point, a budget by department and major cost drivers, I'd say for most small companies, you're not going to be looking at budget by department. You're probably going to be looking at by major cost drivers, and that will be for things like, the major cost drivers to me are salaries, right? So, put the headcount that you're planning on putting in. When you're adding heads, put the salaries in there of the expected level that you're trying to hire. Make sure that you take into account things like payroll taxes, and make sure you're taking into account things like benefits if you offer benefits and overheads associated with hiring. Put those in there. And I say that for most early stage companies that's what you're doing. Obviously, if you're at a bigger stage and a later stage and you have departments, if you have, a VP of business development, and if you have a VP of sales and marketing, and if you have a VP of R&D, and they each have, one or two people or more people, and they have to, manage their own departments, then you would want to do budgets by department. But again, you kind of have to decide for yourself, which makes more sense. And then we've talked about some of these other, key revenue assumptions and key variables already, and those are obviously important. And then the final point is kind of the big one to me is running the different scenarios. So again, this kind of points to, if you put together your financial plan model correctly, what you've done is you've done it based upon, some key assumptions that you've put into the model, and your model should be sensitive enough, and it should be easy to manipulate enough such that you can run different scenarios really, really easily. So for things, for things like, okay, well, what happens if we're able to do more and get more customers per advertising dollar, for example? What happens if we use consultants overseas as opposed to hiring people internally? What happens with that? Run different scenarios and understand, because as you run those different scenarios, what you'll see is where the sensitivities are. Right? You'll see what drives the model. You'll see which ones you need to really, really focus on to make your model and your company as successful as possible. You know, and kind of, you know, I think we've already touched upon this too, but you know, we talk about milestone budgeting and milestone financing is really a key. You know, obviously, if you've been around for a while and you kind of know what your spending has been in the past, and obviously you start with that. And it's kind of easy to put together a budget based upon that. But you know, if you haven't had that, or even if you have that and you know you're going to be growing, or if you know you're going to be pivoting, or if you're going after a new market opportunity, or you're making changes, all those things obviously you'll have to be thinking about, what am I trying to achieve, right? And it's those milestones again. I keep on coming back to milestones, and I always want you to be thinking milestones as you're putting this stuff together. But just make sure that you understand what you're trying to achieve, and that the budget that you're putting together, the hiring plan, the resources that you have in your plan support the milestones that you're trying to achieve. Because really, if you're successful in doing that, then basically what's going to happen is this. You're going to realize that, okay, well, if I've got a company that is based upon profitability and attaining profitability and using cash from customers as a means of growth, you'll be able to achieve that. If you are, you know, looking at, okay, well, look, I'm putting together a financial plan that suggests I'm going to be burning money because I'm trying to develop product and I'm trying to acquire customers, and that costs a lot of money. But these are the milestones I'm trying to achieve. I'm going to hit this many customers paying this much dollars per month, within the next 12 months, and that's my milestone, right? Put that down on paper. Put the resources together, because I guarantee you that if you've done your model correctly, and if you're talking with investors, then when you hit those milestones, that next round of financing is going to go much easier. You're going to get it. You're going to be able to get the valuation that you want, because the valuation is going to come again also from hitting these milestones, and then you're going to be able to raise the money that you want to raise, because you're obviously hitting the goals that you've set for yourself, and the goals that you set for yourself are goals that are going to be make you successful. So that's kind of, I think that the key takeaway here is exactly that. We top-down projections, and I kind of touched upon this.
Sorry,
yes,
sir. I don't mean to interrupt you. I just have one more question before we get going, and it says, are there any thumb rules for the margins and ratios that investors expect? Like, for example, should a B2C business show a margin greater than 60%?
There aren't any hard and fast rules. Again, it's kind of dependent on the kind of company and the kind of product that you have. Obviously, if you have a software as a service company, you're going to have very, very high margins, because product development has already been done, and you've got the delivery, and the costs associated with the delivery is going to be based upon, like, server fees, hosting fees, and there isn't a whole lot more than that there. If you have a product that is a hardware product, right, where you actually have to produce something and you actually sell a hardware, then the margins associated with hardware is a lot lower than you would get for a software company, for example. Professional services, if you have a service company, then the margins look very, very different. So it just depends. But what I would say, if you're talking to investors, if you're talking to equity investors, what that tells me is that you have a business model where, the margins are the margins, and again, I'd say that there's tons of places that you can find where with free data, where you'll be able to point towards, okay, this is what my target margin should be. And obviously, you're not going to get there on day one, but over time, okay, I expect to get to a 60% margin or a 50% margin or an 80% margin business. But really, what's going to drive whether an investor is interested, an equity investor is interested, is in that revenue potential, right? The revenue growth, right? Is this a hockey stick type of revenue potential? Like, investors will not invest in a professional services company just because it's impossible to get that hockey stick. It's impossible for your product to go viral, and for increases in users and increases in customers to become exponential. And that's really what it takes for most equity investors to want to be involved and take equity in your company. And that's probably a discussion for another, that's a topic for another discussion. We do a lot of fundraising type of webinars as well. And so I'll put in a plug for probably a future presentation that we do where we talk about fundraising and what kind of companies investors are interested in funding. But it's about that growth. If you think about it from, I'll just touch upon it really, really lightly for investors. They just want to be able to show a financial plan that suggests that, they invest some money today, and in a 5 to 7 year time period, they expect or they want that money to be worth that they want that investment to be worth 10 times what they're putting in today. And so the financial model that you put together has to support that type of investment thesis. And if it doesn't, you're probably not going to get equity investors interested. Okay, so let's see. Just want to cover the last couple of points before we break and open it up. But just a tops-down projection. Just real briefly here is that you should be doing just a top-down projection, at least on the market size. And here we use terms and acronyms like TAM, which is the total available market, and we use SAM, which is the serviceable obtainable market, and then I'm sorry, the serviceable available market, and we use SOM, which is the serviceable obtainable market. So you could use the comparison of like sushi, for example, right? Sushi may be a $10 billion a year industry, but if you're opening up a sushi bar in downtown San Francisco, then maybe your serviceable obtainable market is within a 2 or 3 mile radius from your company, and so it's in the millions of dollars as opposed to billions. So we use this funnel effect to really calculate kind of what your revenue potential is, and that I absolutely suggest you do that just to make sure that the revenue projections you're putting together from a bottoms-up perspective are at least in line. You're not completely out of whack with your assumptions, because assumptions are based upon just one assumption is being multiplied by another, and we talk about the sensitivity of those. But depending on what assumptions you use, you may come up with a number that is either wholly unobtainable or is ridiculously small compared to the actual market size, in which case then that should make you rethink your assumptions and relook at the financial plan that you're putting together. And then the absolute final point is again just about reforecasting. So, you should be taking it, you should be looking at this, whether you look at it on a monthly basis, whether you look at it on a quarterly basis, whether you look at it on an annual basis. Annual is too infrequent. I'd say for most companies, looking at it on a quarterly basis, I think makes a whole lot of sense. For companies that are moving fast and where pivots are happening. And we're making decisions on new hires because we're really trying to get a product done because we see this market opportunity and we know that there's a small amount of window to achieve it, and so let's jump on it. For companies like that, I would say you absolutely should be doing it on a monthly basis, right? Look at the spending that you spent last month. Hey, this is completely, this is 20% more than what we had just last month, and what does this mean for future months, and what does this mean to our cash flow, and what does this mean to our fundraising efforts, and what does this mean to to profitability? All those questions, depending on where you're at, the stage you're at, how quickly things are changing, you absolutely need to look at this on a regular basis, whether it's monthly, whether it's quarterly, and reforecast, right? Reforecast because every month that goes by, you're getting more experience, you're getting more data, you're getting more knowledge about what's happening with your company, what's happening with the market. You may see prices changing. You may see faster adoption. You may see salary increases happening faster than you expected, and so you have to put together different assumptions for salary for future hires. All those types of things are assumptions that are going to really have an impact on your company and your financials and your projections. So you need to reforecast. And that's at a high level and within an hour. I think that's probably what we want to cover here. We got a few minutes left, so I welcome any additional questions that people have.
I do have one quick question. I wanted to wait to kind of let you get through everything because I knew we were a little pressed for time. But quick question is, are angel investors for the most part also looking for hockey stick growth, or are you referring to more the VCs in that aspect?
They are. I mean, they still are. I mean, angel investors are a little bit different. And again, I would, if you're interested in finding out differences between angel investors and VCs and the different types of companies that angel investors might invest in versus VCs, I would probably point you towards a future webinar that we're going to do, or even just, some, we've got some past webinars on our YouTube page that you could probably go to as well. But and there's a lot more information there. But yeah, they're still looking for the most part, angel investors. The difference between angel investors and VCs is that angel investors just invest their own money, and VCs invest other people's money. The funds tend to be smaller, but they're still looking for the same thing. They're still looking for the X multiple, the 10X multiple on their money within a certain amount of time. They'll invest less money at an earlier stage than VCs, but they're still looking for that. Now, every once in a while, I will say that I've seen angel investors invest in companies without that promise of a 10X multiple, just because it's a personal issue for them. It may be something where they say, oh yeah, I've experienced that. It's really, really frustrating. Or my family and friends have experienced that. We've talked about it, that this needs to change. And you're coming up with an idea where it's addressing an issue, a specific personal issue that they've encountered, and they'll actually invest in a company or an entrepreneur who's trying to address that problem. That's rare, but I've seen it happen. Where even though the promise is, it's clear that you're not going to get that 10X multiple on their investment, that they'll still make an investment in a company, in an entrepreneur who's going after a specific space. They tend to be a little bit more, I'd say, they're emotionally driven as opposed to financially driven than VCs. But for the most part, you should be, when you're fundraising, you should be anticipating and expecting that the same message holds for angels as they do for VCs, which is that they have to have a real big financial return potential for them to invest.
Great. Thank you so much, Sirk. And if there aren't any other questions, I believe that'll bring us to the very end of our presentation. So I just want to say thank you so much to all of you for joining us today. We very much appreciate your time and hope you found this presentation useful. If you have any follow-up questions, please feel free to email us or tweet to @earlygrowthfs, #startupfinance. Our next webinar is scheduled for January 13th and will focus on employment risks. Feel free to register for this as well as any other of our upcoming webinars on our events page at earlygrowthfinancialservices.com. And you can also see a list of other upcoming events in your area. Thank you again to Sirk for a great presentation and to all of you for attending. We hope you have a wonderful day and an amazing holiday season.
Thank you, everyone. I really appreciate you guys taking time, and I hope this was useful. And I'll echo Gina's sentiments for happy and safe holidays to all.
Thank you, everyone. We will talk to you soon.